Yesterday, the Fed made some interesting news. They decided to start aggressively tackling inflation, forecasting 3 interest rate hikes in 2022. As we know, inflation has been a bad boy this last year. According in November 2021, the annual inflation rate was 6.8%, the highest since 1982. According to the usinflationcalculator.com. I'm not going to sit here and talk about the specifics of what they're doing. And instead, I'm here to talk about the effects of housing, because what the experts are saying is this might potentially cause a spike of mortgage interest rates, meaning the 30-year loan that when you mortgage you take when you buy a house, those can potentially start going higher. Right now, the last year, they've been floating, low 3s, sometimes high 2s in some situations. Either way, it's been relatively low, not as low as when the pandemic first hit, but still relatively low. Some people in the space have been theorizing that the rates might even rise as high as 4, maybe even 5. So what does this mean for you as a potential home buyer? Does this affect things? Should you be concerned? And what are my overall thoughts? First and foremost, it does suck that if you're planning on buying a house, your interest rate will be higher, and your brain will tell you, well, geez, if you would have just bought a year ago, your interest rate would have been way lower than this. What is wrong with you? You're a failure. Your dad was right. No, is that just me? Oh, okay. The interest rates going up does suck. You will have to pay slightly more on your monthly payment, and overall, over the 30 years that you're going to be in the house, you will pay more. But there's some potential pros to this, okay? I know, and don't throw tomatoes at me yet, okay? Here's some potential pros of this happening. Historically, when rates have gone up, buyer demand tends to slow down once the rates have hit high, right? And the crazy thing is, what will cause the rates to go higher is now this news of rates going up might cause a hysteria. Maybe it caused a hysteria within you for people to really rush out January, February to go try to lock in a historic rate. Like they always try to get you to lock in the historic rate. And this increased demand is potentially going to lead to the rates going slightly higher. So it's funny it's going to cause that. But either way, if the rates do go up, normally once the rates are higher, buyer demand does drop. So it's not great news for owners if people are trying to sell their house, because a lot of them are selling so they can buy another one. So they probably have a nice low interest rate. They're going to sell their house to less buyers and go buy another one at a higher interest rate. So normally what this does is it takes away a little bit of that demand. Sometimes so even in a world where there's no increased supply, but instead the effects are the demand gets taken away, this could be the thing that we're looking for to start stabilizing prices in some areas. Now, what happens to those people that were looking to buy and they were going to buy regardless of what was happening? It does suck. Like I said earlier, it really does suck. But the benefit of this is if you just decide to wait a little longer, once the rates hit high, maybe delay a little month or two, you might find that the demand has dropped and you won't have to overpay for a house. You won't have to offer $40,000, $50,000. You might not have to waive your appraisal anymore. So that counter effect of higher rates might actually work in your favor if you purchase a house for $400,000. And I am not going to change this. This is usually really wrong for these calculators. For the sake of this argument, I'm leaving the tax and insurance alone. So let's just say your monthly payment is for a 3.2 interest rate on a $400,000 house with 5% down is going to be $1,972. Okay. Well, if you see a house for sale for $400,000 in the last year, you're probably not making an offer for $400,000. You're probably having to make an offer for $420,000. So if you're buying a house for $400,000, odds are this house probably was originally $390,000, $380,000, and you had to offer $400,000 to get it. Okay, so let's say now you're ready to buy, and now houses are $400,000, but once again, people are having to make offers for $410,000, $420,000, etc., etc. Well, if things were to continue to be nice and cheap and the interest rates were low and buyer demand is continuing to stay strong, you might have to offer $410,000, let's say $415,000 to get this house, okay? We increased these to $450,000. Actually, let me correct that because the interest rate, the down payment always changes there. So your payment's actually $2,044. Approximately a difference about $70, $80 around there, give or take. And if you think, well, that's insane, Javier, I would never spend $15,000 more. Well, actually, $15,000 is not bad. Some people go as high as $430,000, $420,000. I'm being very generous by just saying $415,000. Okay, so let's say rates go higher. and the houses are going for 400,000. So let's say your rate is now 3.5 and you're bummed out because you could have got a 0.3% cheaper if only you would have bought sooner. Well, 3.5 interest rate only increases your monthly payment to $2,035. And yes, if you look at an amortization schedule, you definitely will pay more down the road. But you did not have to pay $15,000, $20,000, $35,000, $40,000 for this. And on top of that, if things are just right and demand has reduced, you might be able to get this for like $390. So even at that higher interest rate, your monthly payment still is about the same, right? Because remember, guys, the key, what really affects the market, truly, it's the monthly payment people can qualify for. That's what what caused this market buyer demand to be on steroids for the past 2 years, is when the whole pandemic hit, rates were so freaking cheap and people were just put on overdrive because the monthly payment they could qualify for was substantially better. So they could buy a much better house with less monthly payment because the rates were so cheap. This put them in overdrive. When the interest rates start rising and people's monthly payments are higher for the house they're purchasing, well, then the house that they're buying has to decrease. Therefore, demand drops because a lot of people decide, well, I'm not going to buy a house if I'm going to move to a house like that. Now, I would be interested in seeing, so let's say we go back to $400,000. We go with the 5% down and we go to 4% interest rate. That's going to really cause an effect. And if you really think about it, the person that was trying to buy a house to have that monthly payment for $2,050 is no longer able to afford $400,000. Now they're forced to drop it to $380 to get that monthly payment they want, right? So now people are having to look at cheaper houses, which will knock out a lot of people, but at the same time will decrease demand for those areas that you might be looking in. So in that point, you know, people are like, if their monthly payments they needed to be 2,040, they're going to be making lowball offers. And if, you know, if the lowball offers aren't landing, they're going to have to shift. So I know it sucks. There's always like this huge, I have the buyer remorse, like, damn it, if I would have, like when I refinanced my house during the pandemic, if I would have just waited another 2-3 months, I would have gotten a much better rate. But I did it when I did it, and you have to kind of live with the consequences. The most important thing you can do right now is to not let external circumstances affect your goals. You should still continue and push forward with saving your money that you need to, getting your credit score as high as you need to, getting that job history in, and focus on growing yourself. You cannot change the external circumstances, and if the interest rates do happen to be higher when you're looking to buy a home, it sucks, but it is much better to buy a house that you can afford. Even, and it might not be as nice of a house as you thought it was going to be. Maybe you have to decrease some things, but you can still afford that house. And regardless of what happens to the market, you will be able to be put in a good position where, you know, if something happens, you're going to have enough savings, you're going to have enough good position to be able to afford it. So in conclusion, if you were planning on buying a home based on what you qualify for, you're going to be in a bad spot. The house that you'll be able to qualify for will not be as nice as the one you could have bought 6 months ago. But for those of us that are buying with our budget in mind first, with our monthly payment that works for our budget first, then your budget will be fine and your monthly payment will still work. Now, just like the people that are working on their qualification, they're buying off qualification, is your house going to be as nice? Maybe not, but what's the point of looking at the past and saying, what if? At the end of the day, you're getting ready to buy a house when you're ready. And when you're ready, you buy with what budget in mind, and whatever house it ends up being, as long as it fits your goals and you can afford the monthly payment,
it's all good, man.